In today's episode, we are going to talk about estate taxes because I've encountered a lot of taxpayers where they looked up a certain thing online and they said, oh, I wasn't required to file a tax return because of the estate tax exclusion, but they didn't realize that if the estate actually made any income, that did trigger a tax filing obligation.
Welcome to the Tax Relief with Timalyn Bowens podcast. Are you behind on taxes? Is the IRS threatening you or your business? Are you overwhelmed and confused about how to resolve your tax issues? Let's join Timalyn as she explains your options and how she may be able to help. Timalyn Bowens is America's favorite EA.
Hey, family. Welcome to episode 92 of the Tax Relief with Timalyn Bowens podcast. Last episode, we talked about gift taxes. And in there, I mentioned, if you have a lot of assets and you plan on giving them away, either after you die, you want to be intentional about how you give them away, or if you were doing estate planning, you want to be mindful of the gift tax and distributing certain things before your death. Well, in today's episode, we are going to talk about estate taxes because I've encountered a lot of taxpayers where they looked up a certain thing online and they said, oh, I wasn't required to file a tax return because of the estate tax exclusion, but they didn't realize that if the estate actually made any income, that did trigger a tax filing obligation. Okay, so we're going to talk about what the estate tax is. Then we're going to talk about estate income tax. We're going to talk about what triggers that filing obligation and just some things for you to be mindful of as you are planning either to take care of your estate or if you're the executor on someone else's estate, okay? And I will say, disclaimer, if you're new here, I'm an enrolled agent. I am a tax expert when it comes to resolving tax issues with the IRS. However, I am not a law expert. Why do I say that? To establish a trust, to establish how things are going to look with your estate, the executor, and all those things, you need to work with an attorney, okay? Hands down. Now, when you're building your financial team, there are different types of professionals that you will need. If you live in the state of Indiana, Kentucky, Texas, Virginia, I can give you recommendations for tax attorneys that you can work with to set up a trust, to do your estate planning so things actually turn out the way that you intend. I would be leery, and not to say that other people can't set up trust in estates, but I would be leery of companies where they're like, oh, yeah, we set up trusts, we set up estates, but they don't have that background and knowledge that a tax attorney within your state is going to have. Okay. Because remember, with that type of planning, the same way we have the federal tax law, we also have state tax law. So the way estates go through the whole process and the way trusts are set up is going to be different state by state. That's why I name specific states that I can give you referrals for, because there are tax attorneys I know in those states that I've worked with and I would trust with my own estate planning process. Okay. So now that we got that out of the way, the estate tax is simply a tax on your right to transfer property at your death. Okay. It is going to take everything that you own, which we're going to refer to as assets, and that you have interest in at the date of your death. So that's going to be if you own stock. So you have interest in that company, right? If you're a shareholder or partner in a company, you have interest in that company. Now, when we're looking at all these assets, let's say you have home, you have jewelry, all those things, we're not going to take into account the amount that you paid for those things. We're going to take into account the amount of the fair market value of each item. Okay. The total of this is going to be the gross value of the estate. And like I said, that's going to include your interest in different companies, but it's also going to include real estate outside of maybe the main home. It's going to include insurance policies. It's going to include trust. It's going to include annuities. And as I mentioned earlier, business interests such as being a partner or shareholder in a business. All right. Now, once we've accounted for all of that, we have the gross estate, there are going to be certain deductions that you can apply that will get you to your taxable estate. So if there's property, one eligible deduction would be a mortgage. Then we're going to have other debts. Then we have the estate administration expenses. Having to take care of an estate and make sure everybody gets paid and the stuff is closed out, that is essentially a job. And a lot of people in their estate planning don't take into consideration how much work that person, executor, is going to have to do. So a lot of situations are set up where the executor of the estate will actually get paid for the work that they do. That would just be one estate administrative expense. Okay. We're going to also look at property that's going to go to the surviving spouse. And then we also have qualified charities that may be getting something. And again, all of this is going to go into the planning of your estate before you pass. Okay. Or if you have a parent or loved one that passes and you become the executor, you need to be able to take all of these things into consideration as well. Okay. And again, that's why it's important to work with different experts on a team together. So you have somebody who's the tax expert dealing with the IRS and getting the return filed. Then you have somebody that's the tax and law expert who makes sure that this is set up properly so that your intentions can actually happen legally when you pass. Okay. So after we have all of that taken care of, we will then have the amount for the taxable estate. Now, with tax law that got passed last year, July 4th, 2025, we had the Working Families Tax Cuts. Okay. And all that, the One Big Beautiful Bill Act, all that came out at the same time. So, what does that mean for us in terms of the estate? Well, there's no estate tax at the federal level. Please note me honing in on that federal level. If the estate's taxable value is less than $15 million. Now, this would be on Form 706. The reason I emphasize at the federal level is because we have 50 states who all have states' rights and can decide on how they're going to do things. The threshold here in the state of Kentucky, where I'm at, is much lower and is different than what it is in California or what it is in New York. Okay. So again, when working with a tax attorney, tax accountant, you need to make sure that you are working with people who understand the situation of the state you're in. For me, something happens with my parents, they're not in Kentucky, they're actually in Indiana. So I need to make sure I'm working with someone who is familiar with the Indiana state tax laws, as well as what's going on federal. Because even me, as America's favorite EA, there is a time and place for me to get help and outside expertise that will allow me to still be human, right? Now, with me, lifetime learner and all that, would I still look at the paperwork and everything? Absolutely. But when it comes to this type of planning, you don't want to put the burden of the extra things on you per se, right? You want to allow yourself the time and space to grieve, as well as getting this handled, because we are going to be on the clock with this. All right. When it comes to when this needs to get filed. So for a lot of people, because we have this exclusion of the 15 million for federal for the estate tax return, they think, okay, we're way under 15 million. I don't have to worry about anything. But that's not necessarily true, because that is the tax on the transfer of all that property. What you need to keep in mind is if the estate earned any income. So, up on the date of death, that is when the tax period for that person ended, right? So, let's say we have a parent who dies June 1st, but they have CDs. So, certificates of deposit, sorry, they have savings bonds, they have stock, they have rental properties. Any income that they earn after June 1st, the date of their death. Now, I'm sorry, I don't remember if I said June 1st or July 1st. Let's go with July 1st. Any income that they would earn for the rental properties, for the securities, any of their investments on July 2nd is not considered their income to go on to their final tax return. Anything on July 2nd and later would be income of the estate. So, with that, an estate can earn $599.99 before it has a tax filing obligation. However, if the estate's gross income, so income before any deductions, income before any taxes, is $600 or more, you have to file an estate tax return. And no, this is not going to be Form 706, because that is a state tax based on the transfer of property. This is a state income tax on the Form 1041. And again, $600 or more, that means if you, as the executor, or whoever the executor is, doesn't hurry up and get the property transferred, if it's rental properties, the way rent is right now, that first month, you're probably going to automatically have the filing requirement for the 1041, right? Unless the tenants just didn't pay their rent for that month. You need to make sure that as you're planning for your own estate, you have the information with all of the accounts somewhere that the executor can find it, so they can get stuff moved out of the state and transferred to wherever it's supposed to go. Okay. Because when we're looking at this, the estate return is going to be due on April 15th of the following year. And then the beneficiaries of the estate will receive K1s, and then they'll report their share of the income from the estate using their K1. All right. Now, with that, with the 1041, again, the 1041 is for the estate income tax. The Form 706 is if we have any, the value of the estate is over 15 million. Okay. And when we're looking at that 15 million, let's say you add up all the assets and we're at 14,500,000, right? So 14.5 million. And then we go back through the years and we look at the amount of gifts that were given. you could still potentially get over that 15 million because we have to add those gifts back in. Okay. So it's not as straightforward as, oh my goodness, all their assets are valued under the 15 million. You may get out of having to file Form 706, but you have to be careful if their assets are producing any income, because at that point, you will have to file the 1041. Now, with that though, we're not looking at the typical tax brackets that we usually have, but there are going to be some things on the 1041 that are deductible that are not deductible on your typical 1040. Okay. You have things like the fiduciary fees that can be deducted on the 1041. You have any attorney or accountant fees. So if the money is there and you have it to hire an expert, again, it's going to reduce the amount that you're paying in a state income tax. But in addition to that, is going to give you some peace of mind to be able to work with an expert. Okay. And if any of the beneficiaries are non-resident aliens, you would have to file this 1041 anyway. All right. Now, I try to keep it simple here and not overload you with too much, but I know if you just experienced the death of a loved one and you're having to deal with this right now, everything that I said may be a little overwhelming. You can book a paid call with me at www.bowenstaxsolutions.com. And what I will do, in addition to the show notes, I will begin to put out articles about estate taxes, about gift taxes, so that you have that information available for you. So this doesn't feel like a water hose just blowing you away. All right. And remember, I always say, even if it's not me, get the help you need. Use this information you got now to empower yourself and still take care of the situation. Because if you aren't proactive with this, you may end up getting mail from the IRS. And when you've experienced a death, that's the last thing you want. And I don't want that for you either, because back taxes should not ruin your life. I'd like to thank you for taking the time to listen today. I'd like to thank Jim Ray Consulting Services for helping me get this message out to you. I hope you found the information helpful. Did you know 1 in 50 people have a tax problem? Please share this episode with your friends and family, because you never know who may need help. Again, thanks for listening. Hey, just as a reminder, this podcast is for informational and educational purposes only. It provides a framework and possible solutions for solving your tax problems, but it is not legally binding. Please consult your tax professional regarding your specific tax situation.